All right, chat. Today we have Jerome Powell speaking on the economy. Um, sorry, I'm here eating my breakfast, man. I don't even have a break here to eat my breakfast, but we are eating breakfast right now. Today, Jerome Powell speaks on economic outlook at the 2024 Business, Government, and Society Forum in California. So Powell speaking today. Big report, fairly large. Yeah. Let me know what you guys think. Again, I'm sitting here eating my breakfast, so bear with me. But we do have Jerome Powell speaking in about less than an hour. Let me know right now in chat, do you think Powell's speech will help or hurt markets? Technically, it's an interview. Will today's Powell's interview cause a bullish or bearish? Actually, no. Will Jerome Powell maintain a dovish or hawkish economic stance in today's interview? That's a good question. Let me know in chat. You can also vote on the poll that we're doing right now. Let me know what you guys think. Vote on the poll. You can also let me know live in chat. He speaks around 12 p.m. Eastern Standard Time, or 12 a.m., I'm sorry. Or no, actually, I'm sorry, it's 12 p.m. We will stream the full interview live in its entirety. And again, we're eating our breakfast here, so we'll show my beautiful face in a second. Looking at the markets today, pretty strong action right now. Here's the NASDAQ, very, very strong actually. Huge moves up. Tesla up to 167s. Nvidia all the way over $900. Equities are green today as well. Bear with me. I'll break down dovish, hawkish. Okay, so to talk about what dovish and hawkish means, you have to understand the Fed's decisions and what they ultimately are used for. The Fed is going to be controlling interest rates and doing things to influence interest rates, both short-term, which eventually trickle into long-term. And it depends on what the economic state of the country is. If the country is at fear of a depression or a recession, the Fed will step in and they'll do a lot of different things, but they'll cut rates, which is lowering short-term interest rates. The federal funds rate is the one in reference, and it's the short-term interest rate that banks charge each other to lend money overnight. And so eventually that'll trickle into long-term rates. But if the Fed thinks the economic situation in the U.S. is too little of spending, if we're at risk for a recession and depression from too little of spending, Fed will step in and they'll lower the federal funds rate. Cut rates is what that means. And that will eventually trickle into long-term interest rates like mortgages and auto financing, stuff like that. Because in the logic of that is that when consumers pay less in interest, they're going to spend more money. They're going to have more money to spend on other things. If you're paying less in mortgage interest, you're going to have more money to spend on other stuff, and thus lowering the federal funds rate contributes to more spending, as well as what's called quantitative easing, which just means the Fed steps in and buys up a bunch of treasury bonds and expands their balance sheet. And this allows banks to lower interest rates to consumers. Again, when interest rates are lowered to consumers, consumers tend to spend more, and thus it stimulates a struggling, economy at risk of a depression or recession. That is what's called a dovish Fed, a Fed that wants to bring interest rates down. A hawkish Fed is the opposite of that. If inflation is out of control, because there's, inflation and recession are kind of opposites. Like, one of the consequences of a thriving economy with too much spending is inflation. Prices go up because people are spending so much, businesses raise prices. So one of the consequences of a dovish Fed is inflation. And that's kind of what we're in right now. We're in an inflation market where inflation has been out of control the last few years. A couple years ago it was almost 9%. We brought it down to almost 3%. But a Fed that's trying to reduce inflation and keep interest rates high is called a hawkish Fed. And so a Fed that's fearing inflation is a hawkish Fed. A Fed that's fearing a recession or depression is a dovish Fed that wants to expand the economy. Hawkish wants to kind of push down the economy by keeping interest rates high, basically discourage spending. So that's what hawkish and dovish means. We're going to put a clock up. Give me 1 second. Here we go. So we have about, I would give us about 55 minutes until, I would give us about 55 minutes. 45 minutes, actually. So we have 45 minutes until Powell's technically scheduled to speak. We got about 44 and a half. We'll call it 43 and about 25 seconds. That's probably about accurate. Technically, it's at 12:10, and so that's about right. Sorry, let me get I thought my headphones connected already. Let me make sure. Trying to get my AirPods connected. There we go. All right, so let me reshare this. All right, there we go. Let me fix this. Again, bear with me, chat. Let me know if you can hear the music in a second. You should be able to right now. Inflation over, we will always have inflation. Yeah, I mean, I think inflation is not too bad right now. I still think it's too early to cut rates. I think a lot of people want lower interest rates. But again, like, I hear a lot of complaints on this YouTube channel about a lot of different things. One of the main complaints I get here is prices are too high. They've been too high since the pandemic and all that good stuff. If that's your case, if you think prices are still too high, you do not want interest rates to go down. Like, you do not want interest rates to drop, because that means people are going to spend more and possibly cause more inflation, worse inflation, I should say. And so the people that really want interest rates to drop are mortgage and real estate professionals. They are struggling right now. Really, the last few years, business has dried up, and they want interest rates to go down to help them get more business. Because it's kind of hard to get a mortgage right now, or at least it's not hard, but it's unreasonable to get a mortgage right now at 8% for a lot of people. Will there be a lot of volatility, or can I still trade the SPY? I mean, you can do what you want. I don't know what kind of volatility we're going to get. Powell should move markets. It should be a, 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 a market moving thing. So yeah, this is at the Stanford Graduate School of Business is what this is going to be. Powell's supposed to do an interview at 12:10. And then Michael Barr is supposed to speak at 1:10. But so I don't think Powell. I think Powell's. It's supposed to be about a 50-minute speech, from what I can see. About a 50-minute speech. Since we jump so high, will we fall back down? I have no idea. Nobody knows the answer to that, man. No, truly nobody knows. Again, if you're asking me that, you really got to learn more markets before you trade, because again, nobody freaking knows if the market's going to go up, down, or sideways. Asking some random person in YouTube chat what the market's going to do is, just not a smart thing, I would say. Nobody knows. I certainly don't know. Nobody else does either. I mean, you got a 50-50 chance of being right. You can say yes or no to that question, but yeah, nobody knows, man. Least of all me. I mean, hey, I'm here, top 3 worst traders ever in the world. But yeah. What color tie will Powell wear? I'm going to go with purple. He's been rocking a lot of purple lately for Powell, so I'm going to go with purple tie. But again, let me know what you guys think. Huge spike. Are you a profitable trader? I mean, I made money last year on Thinkorswim. I am currently green this year, at least 4 figures. So, I mean, we're green this year. We made money last year, Although I'm definitely not claiming to be profitable. Definitely not claiming to be a good trader. Yeah. Let's look at our poll numbers here. So, most people think he's going to be hawkish. I don't know. All right, chat. Hey, we got less than 30 minutes. We got the timer up. Actually, yeah, we have about 40 minutes left. A little bit less than 40 minutes, I mean. The biggest question of the day, chat, is who wins, Jake Paul or Mike Tyson? Biggest question of the day. Again, I got to go with Jake Paul. I want Tyson to win. I hope I'm wrong. If anybody watched the Roy Jones Jr. versus Tyson fight, the rules were very similar. Huge 16-ounce gloves. Nobody wins if it goes to a decision. You know what I mean? Like, it seems to be an exhibition nonsense fight. So, but I think Jake obviously has the edge and power. And Mike Tyson's 60. It's just not a reasonable thing, in my opinion. I'm not sure what they're thinking, but hey, I hope Tyson does it. I hope I'm wrong. I hope Tyson does it, but again, he's 60, So we'll see. We got Big Papa Jerome Powell. The Nasdaq's flying up. Tesla up. Nvidia up. today too. Very green day. What started off very red. Again, people were saying the bear market. You see how polarized short-term traders are. Earlier today, people were saying the bear market is back. It's a market crash. And now the market's flying up. I mean, again, people need to take a step back. When in doubt, zoom out is the very famous saying. If you're looking at markets too magnified, when in doubt, zoom out. Okay. Currently, NASDAQ is up. Tesla over 168 currently. Nvidia over 900 again. Will it break 1,000 anytime soon? Hawkish means fearing inflation and they want to keep interest rates high. Dovish means fearing recession, depression. They want to keep interest rates low and expand the economy. That's the two different things. Yo, remind me to swap my headphones out, chat. Why are people saying he said he wouldn't cut? I don't know where folks got that from. Yeah, I'm not sure. I think he'll probably cut sometime this year. Mighty guess it's June. And if we look at the CME watch tool, gauging when a cut might potentially happen, people aren't predicting a cut all the way until June, I believe, is when it pivots to most people expecting a 25 basis point cut. Yeah, so June is when most people are betting on a rate cut. You know, still at the same time, it's not it's not like really swayed to one side. 42% of people still expecting a pause. 1.5% of people expecting a 50 basis point cut. This is 25 right here. And then this is a pause. So yeah, that's the statistics, or the probabilities, I should say. Regarding it, Tesla moving up towards highs of the day. Nvidia, let's see if Nvidia holds at $900. And I do think Powell might influence things. He's supposed to speak about the economy. Yeah, I don't think a cut too early is good. I think inflation is still a problem. Definitely one at least. Yeah, I think we're going to cut. I don't think it'll be until June, and I think it could be July or longer. It's a beautiful day here, Chad. It's a beautiful day. Apple testing highs of the day again. Look at Apple up here. So there's Tesla. Look at Apple. Apple up to 170 plus. You know, it's funny. Like just earlier, people were talking about Apple getting removed from the Magnificent Seven, and now it's not a growth company anymore, and all this stuff. Like, day traders are so polarized, man. They're so short term. Bitcoin dropping, is it really? Bitcoin at 66.3s. Yeah, Bitcoin dipping down a little bit. Microsoft up there at 423s as well. Meta up there breaking highs at 506s. My bet is cuts for political reasons. Economy is too good for a cut right now. Maybe. I think the economy's okay right now. I think a cut's too early. I think that the economy's strong enough currently to where we don't need to cut. Cuts are there if we're at recession or depression risk. Not always. I mean, it sounds like the Powell decision is going to be the base case. Is going to be at least one cut this year. So we're probably going to cut rates at least once this year. And I don't think that necessarily means we're going to be anywhere close to a recession or depression. I just think they're going to think inflation is at a reasonable level to start bringing interest rates back down. But I don't think the economy is at risk. And so I think too much cuts this year could be disastrous for inflation. And I don't want that. In my opinion, JP will boast about the resilience in the economy and markets take a dip, but who knows? So you think he's going to be dovish? Intel's dipping. Yeah, Intel at 41s. So Intel's mostly sideways since the opening bell, though. It had a pretty brutal drop in pre-market, though. So most tech is up today, of course. Nvidia's up. Apple's up. This is mostly from services PMI. Services PMI showed up and just boosted the market. Again, we covered services PMI at 10. And you can see at 10 o'clock market time, just a big boost. Services PMI came in lower than expected, signaling less economic growth, probably less of a need for inflation rate hikes and stuff like that is probably why the market reacted so favorably to lower than expected ISM non-manufacturing services PMI. It came in at 51.4. They expected 52.8. So a lower PMI reading means that there's less expanding in manufacturing. And that's probably good for inflation, right? I think that's what everybody's so optimistic about regarding this. I like Rhythmic much better. I like Rhythmic much better. Rhythmic, less lag problems. This is Rhythmic right here. I'm using Quant Tower, but if you're using Apex, you can also use Ninja Trader. But I like Quant Tower with Rhythmic right here. If you use my promo code BT, you'll get 80% off. Max discount if you use my promo code BT. Is services PMI better indicator than CPI or PPI? No. Services PMI is expansion or contraction in services sector. While it's a gauge of, how the economy's doing, if we're directly looking at inflation, we want to look at CPI, PPI, PCE data, core PCE specifically. Those are the major inflation metrics that you want to watch. PMI came out about an hour and a half ago, an hour and 40 minutes ago. What about the Dow? What about it? It's green today, 39.24s. So we got over 500 people here already. Still got about 30 minutes or so before Big Papa Powell speaks. Buying crawfish plates right now. We ate some crawfish on Easter. I hope you guys had a good holiday. NASDAQ still testing highs up here. You can see NVIDIA bouncing right at the $900 level. SPY going red. Let me see. No, SPY all the way breaking highs. Up to almost 521s on the SPY. Mr. B, thanks, man. Just a slow grind up today. Watch daily. For about 18 months, did well with your guidance and suggestions. Had to break away for a while. Just started back again. Was devoted to you before. You have me again. Hey, thank you, man. Appreciate it. Again, I'm not an investment professional. Remember, I have no idea what I'm talking about. I might be wildly wrong about anything I say. Do not copy me. I'm not an investment professional. I'm not liable if you lose. You always got to make your own assessment. Trade smart. Remember, John in beginner trading has no idea what he's talking about. Do not copy me, Chad. I appreciate the love. Thanks so much. We're going to stream the entire Powell speech live here, though. We typically get a lot of people for these, so that'll be fun. All right, will Powell help or hurt the market, Chad? Is the big question today, I think. He will say economy looks good, inflation is sticky, Fed needs patience, we'll cut later this year, no action now. Yeah, that's almost certainly what he's going to say. Is this a special speech or normal? It's a special speech, I guess is what you want to call it. It's not the normal FOMC meeting. The next FOMC meeting is in May. You get people from all over the world on these. Yeah, for sure. We get a lot of people. Hey, thank you, mister. I want Powell to stop the gold bull run. Why? Yeah, Apple treat me right today, so Apple is doing okay. I'll take that. I don't ever trade the Russell. I'm not a big small cap guy. I don't really like small caps. What's up, Ariels? Powell will fuel the bull run? I hope so. Silver and silver mine stocks are going way up. Are they really? What's the silver symbol? I think it's like SLV, right? Oh, wait, what is it? SVM, is that right? What's the silver futures contract is what I'm looking for. I know gold. I don't ever trade silver, so I don't really know. Microsoft breaking highs. What is AMD doing? AMD Green Day as well, up to 181s. Tesla pulling back a little bit. All right, we've got about 15 minutes or so until SIL. Yeah, that's what it is. It's SIL. 1,000 ounces of silver is about $26. Silver's been on a bull run too the last 10 days with gold. Gold's been really running. Silver's been ripping up since March. So. All right, chat. We got a decent amount of time left. Still got 20 plus minutes before the speech starts. We are ready, live, waiting. Let's pull this up. We'll get it up ready here so you guys can. Oh wait, this is in 7 hours. That's not the right one. Here we go. This is the right one. We're gonna have to mute the music pretty soon. Jerome Powell speaking at 12:10 to 12:55. So we got the Google CEO Sundar speaking from 10 to 10:45 Pacific. So that's about 1 to 1:45. PG&E CEO Patty K. Pope speaking from 4:15 Pacific to 5 p.m. Pacific. So that's fun. Get this up here. Try to move this symbols down, up. Can you see this? Is anything blocking it? Let me make sure. No, a little bit higher, I think, right? this over. There's one chart up here. All right, so we got the NASDAQ. I'm gonna put like what, the dollar index. We'll put the SPY up. We'll put the NASDAQ and then the SPY up on the top right, huh? That probably works, right? Here we go. We drop this a little bit, right? Let's see. There we go. I think that's pretty good. Fed is committed to at least 2 cuts. Fed's daily said 3 cuts is reasonable base. What caused the jump earlier? ISM services PMI. ISM services dropped at 10 o'clock, and you can see the big follow-through bounce from that. Dropped right here, and then boom. Services came in lower than expected, showing less expanding services sector than expected. Probably more optimistic regarding inflation is what's going on there. I do a little bit of both, Aldrin. All right, chat. All right, chat. Really, we technically have 18 minutes. 18 minutes. We're going to go ahead and switch our headphones out just to make sure we don't forget. My hair's sticking up a little bit in the back, so the headphones will also help keep my hair, you know, nice and stylish for you all. What's your favorite divvy stock? Home Depot, probably. Home Depot lately has been really, really good. All right, let me make sure you guys can hear the music here. Hold on, chat. Let me make sure. It's time for me to get a haircut for sure. All right. Can this push my hair back in the back, down in the back a little bit better? You know? There we go. All right. Can y'all hear the music? I guess is the question. Scruffy the janitor? Yeah, that's me, bro. In my mom's basement, man. What do you expect from Powell's statement? How will this affect the market? I'm not sure. Again, we're just guessing. I hope it comes in optimistically for the economy. I hope he's I don't know. Dovish is probably going to cause more positive reactions, signaling a stronger economy, less of a need for rate cuts, or less of a need for keeping interest rates high, stimulating the economy. But I personally believe that we need a more dovish or a hawkish Fed to keep rates longer. I'm fearing inflation still. I don't want inflation to spike. So. Yeah. Put out some better music since you guys don't like my music here. What's dovish and hawkish? Dovish means dovish means the Fed wants to bring interest rates down to stimulate the economy, and they want an expanding monetary policy, meaning they're expanding their balance sheet with quantitative easing. They're buying up a bunch of treasury bonds, expanding their balance sheet, which ultimately injects liquidity into the market, into the economy, allowing banks to lower interest rates to consumers. Dovish essentially means the Fed wants to bring interest rates down, stimulate spending in a positive way. Hawkish means they want to keep interest rates high. They want to raise federal funds rate. They want to keep interest rates high because inflation's a risk. And so dovish means a Fed that wants to stimulate the economy, cut rates, expand their balance sheet, injecting liquidity, and allowing banks to lower interest rates to consumers. Basically, dovish means they want to keep interest rates low. Hawkish means they want to keep interest rates high. They want to. Hawkish with quantitative tightening means they want to essentially stop expanding their balance sheet, let their current holdings mature and run off, and that will cause banks to raise interest rates to consumers. So lately, we're still in a period of QT. We're still tightening. We're still hawkish Fed, technically by nature right now, with keeping interest rates high. Interest rates are still high. The Fed said they're going to pivot out of QT sometime this year, most likely, maybe next year. And the other question is, when is the Fed going to start cutting rates? Ending QT would be a dovish thing. Cutting rates would be a dovish thing. Again, the question is it too early? Do we need interest rates to go down right now? Again, if you're worried about prices being too high, cutting interest rates to consumers is not necessarily the right move, in my opinion. I think it's going to make inflation problems worse. And I don't think the economy is anywhere near a recession or depression. We have GDP growth. We have a lot of spending. Jobs are good. And so I think if we cut rates too early, we could trigger more inflation problems. But I think the Fed's base case right now is one cut at least this year. They're talking about maybe June is when they're going to cut rates. Again, what Powell will probably say in this is that the base case is a rate cut this year, at least one. And I just want them to not do it in May. So yes, he's talking in 13 minutes. Yeah. So, we're here. We're waiting. All right, so just to clarify again, y'all can hear the music, correct? Every time Powell speaks, the market dumps. Is this true? No, it's not true at all. Sometimes it rips, sometimes it crashes. Or not crashes. Sometimes it pulls back, sometimes it rips. This man has drank way too much from the government Kool-Aid. I mean, I don't think I said anything super polarized to one side or the other. I was just explaining economics, which is a hawkish or dovish Fed, what the Fed does, all that stuff. I'm not saying everything's great and rosy right now. I'm saying that's economics, rate hikes, quantitative easing, that's what those things are. Again, me saying it's too early to cut rates is not a... again, the Fed seems like they're going to cut rates regardless. And again, I disagree with them in that way. I think it's too early to cut rates soon. I think we need to push it back because inflation problems could arise from it. So, yeah, I mean. Again, chat, real quick. Can you hear the music? Yes? Okay, good. All right, so we're going to mute the music now, and we're going to get this live ready to play. I'm assuming they're playing really bad hold music. Play some music, I guess. I don't know what kind of background music they're playing. Good. Bias for this speech? I don't really have one. I think I think Powell's probably going to say something along the lines of, we're not out of the woods yet regarding inflation, that we're still going to approach it in a balanced case-by-case basis, maybe, or not case-by-case. We're going to approach it in a they're waiting to make a decision, but they think the base case is at least a cut this year, and that they're going to end quantitative tightening sometime soon, over this year, next year, is what I think they're going to say. Whether that's good or bad is up to interpretation. I'm not sure, but that's my guess, is that they're going to end QT. They're going to, sometime this year, next year, they're going to start pivoting to rate cuts sometime this year. Data driven, yeah, that's probably a better way to say it. What will be his exact words to determine rate cuts or not? We're going to cut rates this year, you know. And if inflation is bad, they're less likely to cut. If inflation is good, and he is optimistic regarding inflation, they're more likely to cut. And I think right now he's more optimistic regarding inflation, and they're more likely to cut rates, is my guess here. So. All right, chat. We're here. Make sure my volume's up. Yep. There we go. Volume is up. I'll let you guys know when they actually start talking. Make sure we're live. We're live. Okay, good. I think Powell wears a Rolex. I'm pretty sure it's a Submariner Rolex. All right, chat. I'm going to end this music because they're going to get ready to speak sometime soon. So we're just going to sit tight. SPY pulling back a lot, honestly, leading up to this. Again, we're completely live here waiting. Yeah, so. Waiting for them to start. We're going to watch the market and the economy leading into this chat. Powell has not spoken yet. He's going to speak in about 8 minutes or so. So right now we're just waiting. Time will tell. We got the closed captioning on as well. We got about 2,000 people here live. NASDAQ's pulling back some, so we are getting some red action ahead of Powell. I guess market participants are a little bit bearish regarding Powell. Probably Brian. Brian says our market's heading down right now. Here we go. Sound check. Can you guys hear this? Should be good.
Good morning. Good morning, everyone. Woo! Welcome, welcome. My name is Maria Franz. I am the director of the Business Government Society Initiative. It is an absolute thrill to be here today and to welcome you to our inaugural forum. I just want to thank you for spending time out of your busy lives to come and spend it at Stanford and help to contribute to what we think is going to be not only a great day, but a great initiative. We have an exciting morning planned, so let me kick us off by introducing our first speaker. Jonathan Levin is the Philip H. Knight Professor and Dean of the Stanford Graduate School of Business. He's been dean since 2016. He's widely regarded for his academic scholarship in the fields of microeconomics and industrial organization, having earned the John Bates Clark Medal for Outstanding Excellence by an American economist under the age of 40. He also serves on President Biden's Council of Advisors for Science and Technology. Please join me in welcoming Jonathan Levin.
Thank you, Maria. Great, so thank you, Maria. And Today's a really wonderful day for the business school and for Stanford, and thank you for being a part of it. The Stanford Business School has an inspiring mission, which is to create ideas that illuminate management and to educate innovative, principled leaders who will change the world. When I became the business school dean in September of 2016, there were many things that I knew would be important to advance that mission. Building the excellence of the faculty, elevating the school's position in management education, expanding our global footprint, forming new collaborations across the university. And what I did not expect at that time was just how profoundly the demands on business and on organizational leaders would change. The speed of changes in technology, the political landscape, the expectation that business leaders would have to have a viewpoint and speak about societal issues, or at least would be expected to do that on a regular basis, as well as thinking about their own strategy and operations. And more broadly, increasing skepticism on both the left and the right in this country and in different parts of the world about capitalism and its ability to generate shared prosperity. And of course, education at the Stanford Business School is premised on the belief that organizations and markets and democratic institutions are a powerful force, perhaps the most powerful force to drive societal progress. And also on the belief that by preparing students as leaders, we can bring the ideas of our faculty to life and make a significant contribution to the world. Or as we say, to change the lives of our students and then have them go out and change organizations and change the world, as our motto goes. And during the pandemic, we developed the idea for the Business Governance Society Initiative with the idea that it would give us a chance to put the school at the forefront of emerging areas. So debates about free markets and governance and regulation, advances in technology, sustainability and energy transition, and in that way respond to the changes in the world and get ahead of them. And our goal, of course, was to bring our research and teaching to bear on those issues. That's what we do best. That's the school's core. And then to integrate them into how we think about leadership education. And in the last 2 years, that initiative already has generated new classes and new conferences, new workshops. It's supported more than 60 faculty research projects. It's led to the development of a leadership values survey that we now give to all of our incoming students and to our alumni starting this spring. It's fostered a strong partnership with the new Dorr School of Sustainability and other schools across campus. And one of the ambitions that we have had with the initiative was that we would be able to try to use the school, power of the school, to spark discussions among faculty and students and leaders from business and government and civil society. And this forum is very much in that spirit. And the idea for this forum actually came from a task force that I convened during the pandemic, led by Professor Ken Schatz and Jim Coulter, one of our alumni, and involved faculty and students and staff and friends of the school. Last week I went back and read the final report of that task force, which was articulating a vision for this Business Governance Society initiative. And it was very interesting, actually, in light of subsequent events, to go back and read that report, because it focused largely on two things. It focused on the school's role in promoting leadership responsibility, which is, of course, the title of this forum, and it focused on civil discourse. And this is written in the spring of 2021, and I'll just read you from the first three paragraphs of the report that was written at the time, and which I just thought was so apropos of the world we're living in today. The report said, the Stanford GSB must prepare students for the responsibilities of leadership. To be clear, preparing students for leadership does not mean prescribing a particular set of values. It's not our role to tell students the right answers to difficult questions about policy or the social responsibility of business. That is something they must decide for themselves based on their own values. But we do have a responsibility to make sure they thoughtfully engage with these questions and have the knowledge to make informed decisions. And I think that's a perfect introduction to today's event. We're not here to receive answers, but to learn something and engage in a discussion. And we're very fortunate to have some exceptional guests here today and speakers, and to have an agenda that tackles a fascinating set of issues. So thank you all for being here, and I hope you all have a great day. And now, to get things started, I'm going to introduce our first speaker, who's Federal Reserve Chair Jerome Powell.
Here he goes.
Jerome Powell, Chair of the Federal Reserve, was appointed in 2018. He has had quite an interesting 6 years at the helm of the Federal Reserve, as interesting as any Fed chair in recent memory, although there have been quite a few interesting episodes for Fed chairs in the last 20 or 30 years. He has guided the Fed with a sure hand through a global pandemic, supply disruptions, an incredibly dramatic fiscal expansion, a lot of asset market volatility, first inflation of magnitude in many years, and somehow we've emerged with the US economy continuing to create jobs and be the envy of the world. And that range of experience, as well as Chairman Powell's responsible leadership, make him a perfect first speaker for our event. He is going to share some opening remarks, and then he's going to be joined on stage by Arvind Krishnamurthy. Arvind is the John Osterweiss Professor of Finance at the GSB, and he is himself an expert on asset markets, financial intermediation, and monetary policy. So with that, it's a pleasure to welcome Chairman Powell to the stage.
Here he comes. Hopefully they say some economic stuff about the current economy. You know, we have the NASDAQ on the left, you know, SPY on the top.
Thank you very much, Dean Levin. It's great to be here today. Thanks to everyone for coming out. It's a pleasure to be here. So I'm going to begin with some comments on the economy and the road ahead for monetary policy before briefly discussing the Federal Reserve's monetary policy independence, and then joining Arvind Krishnamurthy for some discussion. So over the past year, inflation has come down significantly, but it's still running above the FOMC's 2% goal. In February, headline inflation was 2.5% over the past 12 months based on PCE index. A year ago, it was 5.2. Core inflation, which excludes the volatile food and energy components, stood at 2.8% in February. A year ago, it was 4.8%. So this is very welcome progress, but as you can see, the job of sustainably restoring 2% inflation is not yet done. Tight monetary policy continues to weigh on demand, particularly in interest-sensitive spending categories. Nonetheless, growth in economic activity and employment was strong in 2023, as real GDP expanded by more than 3%, and 3 million jobs were created, even as inflation fell substantially. This combination of outcomes reflects significant improvements in supply that offset to some extent the effects on demand of tighter financial conditions. The healing of global supply chains helped address pent-up demand for goods, particularly in sectors that had faced considerable shortages, such as autos. In addition, labor supply increased significantly thanks to rising participation among 25 to 54-year-olds, workers in their prime working years, as well as a strong pace of immigration. Recent readings on both job gains and inflation have come in higher than expected. The economy added in an average of 265,000 jobs per month in the 3 years through February, a faster pace than we have seen since last June. And the higher inflation data over January and February were above the low readings in the second half of last year. But these recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. Labor market rebalancing is evident in many parts of the data, including quits, job openings, surveys of employers and workers, and the continued gradual decline in wage growth. On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%. Given the strength of the economy and progress on inflation so far, we have time to let the incoming data guide our decisions on policy. We've held our policy rate at its current level since last July, As shown in the individual projections that the FOMC released just 2 weeks ago, my colleagues and I continue to believe that the policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as we expect, most FOMC participants see it as likely to be appropriate to begin lowering the policy rate at some point this year. Of course, that outlook is still quite uncertain, and we face risks on both sides. Reducing rates too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. But easing policy too late or too little could unduly weaken economic activity and employment. As progress on inflation continues and labor market tightness eases, these risks continue to move into better balance. As conditions evolve, monetary policy is well positioned to confront either of these risks. We are making decisions meeting by meeting, and we'll do everything we can to achieve our maximum employment and price stability goals. And that brings me to my second topic. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. Our success in delivering on these goals matters a great deal to all Americans. To support our pursuit of these goals, Congress granted the Fed a substantial degree of independence in our conduct of monetary policy. Fed policymakers serve long terms that are not synchronized with election cycles. Our decisions are not subject to reversal by other parts of the government other than through legislation. This independence both enables and requires us to make our policy decisions without consideration of short-term political matters. Such independence for a federal agency is and should be rare. In the case of the Fed, independence is essential to our ability to serve the public. The record shows that independent central banks deliver better economic outcomes. We recognize that we need to continually earn this grant of independence, and we do so by carrying out our work with technical competence and objectivity in a transparent and accountable manner, and by sticking to our knitting. By technical competence, I mean that the Fed policymakers use the most up-to-date information and research to deepen our understanding of the ever-evolving economy and to reliably deliver on our assigned goals. We're supported by a highly capable staff. We also draw on the insights and experiences of a wide array of business, academic, community, and labor leaders, as well as others engaged in the economy. And by objective, I mean that our analysis is free from any personal or political bias in service to the public. We will not always get it right. No one does. But our decisions will always reflect our painstaking assessment of what is best for our economy in the medium and longer term, and nothing else. Transparency and accountability are fundamental for any government agency in a democracy, but are especially important for one granted policy independence. The Fed has a special obligation to explain ourselves clearly, to describe what we're doing and why we're doing it. We're always striving to improve this communication, and it is a job that is never complete. But we've come a long way. Before 1994, the FOMC did not even announce monetary policy decisions. Today, we announce those decisions, and we explain the thinking behind them in our post-meeting statement and press conference. We publish detailed minutes of our deliberations and a quarterly summary of economic and policy projections of each FOMC participant. We publish a monetary policy report twice a year, and the chair appears before Congress to present that report and to answer any and all questions that are on the minds of our oversight committee members. In 2020, we completed a year-long public review of our monetary policy framework, and late this year, we will begin just such another review. My colleagues and I explain our views on the economic outlook and monetary policy in speeches like this one and in visits to communities around the country as part of an extensive outreach in which we seek input from individuals and groups throughout society. Transparency is an affirmative and proactive commitment to the public. Lastly, to maintain the public's trust, we also need to avoid mission creep. Our nation faces many challenges, some of which directly or indirectly involve the economy. Fed policymakers are often pressed to take a position on issues that are arguably relevant to the economy, but are not within our mandate, such as, for example, particular tax and spending policies, immigration policy, and trade policy. Climate change is another current example. Policies to address climate change are the business of elected officials and those agencies that they have charged with this responsibility The Fed has received no such charge. We do, however, have a narrow role that relates to our responsibilities as a bank supervisor. The public will expect that the institutions that we regulate and supervise will understand and be able to manage the material risks that they face, which over time are likely to include climate-related financial risks. We will remain alert to the risk that there will be pressure to expand that role over time, but we are not, nor do we seek to be, climate policymakers. In short, doing our job well requires that we respect the limits of our mandate. Thank you. I'll stop there and look forward to our discussion. Thanks.
Thoughts, chat? What do you guys think about that? Dovish or hawkish? What do you guys think?
Thank you very much, Chair Powell, for those remarks and for taking some time to be with us and talk to us today. There's a lot of stuff going on in the world today. I think we have a lot of stuff to talk about, so I'm going to get right into it. Before I get started, I just want to also thank you to the audience for sending questions over. What I've done is I've tried to organize the conversation around two themes. One, we'll start by talking about the macroeconomy, and then you have been shared through a very tumultuous period over the last 5 years, and I want to talk about the leadership challenges around that. So let me just dive right into it, pick up on something you started talking about, which is inflation. 2 years ago, we had inflation readings close to 6-7%. We've come down to 3%. Last Friday, the PCE inflation index, the personal consumption expenditure inflation index, which is something the Fed often speaks about, came in at 2.8%. We've had a conversation about this. There's so many factors that have been play in the economy over the last couple of years. I wonder if you can just spend some time talking to us about what you think are the key factors that have brought inflation down over the last 2 years.
Sure. So I think I'll start with where we think the inflation came from. So what is actually different this time, at the risk of making that statement, is that this inflation wasn't strictly just a question of demand overheating and the Fed coming in and having to suppress demand. That's been the more typical pattern, perhaps on the back of a shock such as oil price shock and that kind of thing. This episode actually also involved, as everyone will recall, the collapse of the supply side in a lot of ways. So supply chains stopped working. There were shortages of critical things like semiconductors, which turned out you couldn't make cars. I think many of us might not have realized how many semiconductors go into a car. In addition, there was a major labor force shock. So we lost several million people out of the labor market. So we had a very severe labor shortage. So it was a supply side issue, as well as overheated demand from the closing and then reopening of the economy at a time when rates were low and fiscal policy was very supportive of demand. So we had both of those things. And therefore, if those were the causes, what we needed to see was both the unwinding of the pandemic-related distortions to both the supply and demand in the economy, and also the effects of tight monetary policy. So today, what we think we're seeing as inflation has come down sharply over the last year is those two factors working together. And they do work together. We think that tight monetary policy weighing on demand actually gives the supply side a better chance to recover. And 2023, of course, was a year, as I mentioned, of very significant supply side recovery and expansion.
And what are the factors that you're keeping an eye on, say, over the next few years, maybe the next year or two, that might play out in the inflation picture?
I should also mention inflation expectations, which in our framework and in the thinking of most monetary economists, people think that having the public expect inflation to return to 2% despite it moving up, that's a very important factor in bringing inflation back down. In a sense, if people believe it, that price setters and wage setters in the economy, if they believe that inflation will be 2%, then that'll actually happen. So as we look ahead, though, one question is how much more juice is there to come out of the supply side recovery? We got a very large increase in population last year, which may have helped with inflation. It certainly helped with output, and it increased the potential output. At the same time, the economy is growing 3.1% last year. Around that, we also had inflation coming down sharply. So there may be more supply side gains to be had. Surveys of businesses still show difficulties in hiring people, different difficulties in in getting the inputs that they need for their businesses. So there's some more benefit there. We also think that monetary policy is tight. It's weighing on interest-sensitive spending in the economy. So, for example, durable goods, surveys of consumers will say that it's a tough time to buy durable goods because rates are high. You also see the labor market rebalancing because you can look at demand in the labor market as well as supply, but you see demand reflected in lower job openings, a very small increase in unemployment, in wages moving back down toward more sustainable levels. So we think those two forces that I mentioned will be the ones we'll be looking for. And the thing we'll be looking at, of course, is the incoming data on inflation as those affect the outlook, and the same thing about the labor market. What's happening in the labor market? Does it suggest that the labor market is continuing its progress, and it's made substantial progress, to get back to a sustainable level of wage growth and balance between supply and demand?
Can I just dig into the inflation expectations point you mentioned? An analogy that people drew a couple years ago was to the high inflation episode of the 70s, where we had a high inflation period that then ended up shifting expectations, then through the wage price mechanism ended up leading to a sustained period of high inflation. In the current situation, I guess I have two questions. How concerned are you about maybe inflation getting stuck in the upper twos, around 3? Could that last mile be very hard because inflation expectations getting stuck? And then relatedly, are there things you're looking at to tell you, to signal to you that that is an issue or isn't an issue?
Right, so as I mentioned, inflation expectations we think are an important part of driving actually inflation. And we want them to be at levels that are consistent with 2% inflation over time. Not 3%, but 2%, not 2.5%. The good news is that that's where they are right now and pretty much have been for some time. And we look at surveys of businesses, households, forecasters. We look at other kinds of measures of inflation expectations, model-based and things like that. We also look at market-based. The market is always buying and selling inflation protection, and you can get from that expectation of or assessment of what markets expect. And all of those are pretty consistently saying that the public does believe, and it's a good thing because it's true, that inflation will go back down to 2%. So that's very assuring, but that's partly because of the very strong action that we took and also because of our ongoing commitment to actually return inflation to 2% over time. So, and that is our commitment, by the way. But over time, so I would say it would be a concern if inflation expectations were not to be consistent with the outcome that we seek. But the good news is they're not, and I think our commitment is understood and respected and believed by the public, and that's as it should be.
Let me flip to the other side of the equation. We've had employment, economic activity that remained quite strong. The unemployment rate it's remained below 4% for the last 2 years. And this is during a period in which you've took the funds rate from 0% to 5.3% in about as fast a rate hike cycle as we've seen in history. A year ago, many people were talking about possibility of recession. That hasn't happened. Again, you made some remarks about this, but I wonder if you can just go a little bit more into this. Why hasn't this happened? Why have we achieved what looks like a soft landing, which is inflation coming down, unemployment remaining low? What are the factors that have played out? And then the related question, do we think this will continue to happen over the next year or two?
Yeah, so I guess I've always had the view and always said that because of the unusual origins of this inflation and its differences from other prior episodes, there was a path to getting inflation back down, restoring price stability, getting inflation back down sustainably to 2% without the kind of large job losses and increases in unemployment that have been typical of prior tightening cycles. And the reason, again, was that some part of this was independent of demand. If you have to get all of the inflation reduction gains from suppressing demand, then the chances are that will involve that will weigh on employment and economic activity pretty significantly. But here we had we had, the situation for against semiconductors. You couldn't buy a car at the very time when people wanted cars because they were moving to the suburbs, because they didn't want to ride on public transportation because of COVID. At that precise time, the supply of cars went down dramatically because of the shortage. So what happens is the prices went way up. That's how the market clears in our economy. So on the other side of that, though, without respect to demand, once the semiconductor supply comes back, you should come right back down that curve, and you could, in principle, get inflation down significantly without just ignoring demand for a second. Mm-hmm. So I always thought that was possible, and I would say something like that appears to be happening. Sorry. So then your question is, how did that happen? So more recently, we expected that to happen at the very beginning, and that's why we thought the inflation was transitory, meaning it would go away quickly without much effort from us. That turned out not to be the case. And we thought then that was in 2021. In 2022, we thought the supply side would recover more. It really didn't, and I certainly began to wonder whether that was going to happen. And then it really happened in 2023. Right about the time we were almost ready to give up on supply side recovery, you got this significant increase in labor force participation, accompanied by a significant move up in immigration, and you also got the unwinding of the supply side problem. So what's happening is when that happens, potential output is going up significantly, the economy's productive capacity. So you have a situation where productive capacity is going up even more than actual output. And so the economy actually isn't becoming tighter, which it ordinarily would. It's actually becoming a little looser, and you're seeing inflation come down. Very unusual situation. The pandemic has been a textbook of unusual, unexpected developments and situations. But that really is the story. And then Arvind, the question is, how much more are we going to get out of the supply side recovery, and how much will fall to demand? And we just don't know the answer to that. We're not going to prematurely assume that there's no more progress to be made on the supply side. Indeed, the evidence is that there probably is more gain to be had there.
You had mentioned immigration has been a big part of the last year or two in terms of the supply side. Can you just expand on that? Is that how important is that relative to supply chain? Where do you see that playing out over the next year or two?
So I need to start by saying that the Fed is not an immigration policymaker, and don't comment on those who do have that assignment or the policies that they make. It's really we're just calling the balls and strikes on the economy as we see them. And so from that standpoint, our economy's been short labor, and probably still is. If you talk to, and we do talk to a lot of business people, it's still difficult to hire for many companies. So we've needed more people. But what happened over the course of last year is, to a much greater extent than had been thought, immigration moved up quite a bit over the last 2 years, and this is. Typically, the Census Bureau does all this estimating. The Congressional Budget Office actually went and took a different path and talked to the people who work at the border and that kind of thing, and got a much higher estimate, which now many groups have gone out to validate. And I would say it's clear there's something there. The numbers are actually higher, and that actually explains what we've been asking ourselves, which is how can the economy have grown over 3% in a year where almost every outside economist was forecasting a recession. An overwhelming majority, anyway, were forecasting a recession for 2023. Not only did that not happen, we had better than 3% growth. So really a remarkable performance, and some part of that is that there are significantly more people working in the country, but then how does inflation come down? It's because the capacity of the economy has actually moved up perhaps more than the actual output. So it's a bigger economy, but not a tighter one. Really an unexpected and unusual thing. Again, we don't make judgment calls, but that's what we're seeing.
So it's interesting in this discussion we've had about inflation and unemployment. We have talked about real factors, immigration, supply chain healing. That's the stuff that seems to have played out. We haven't really talked about interest rates per se, which is, of course, the primary tool of the Federal Reserve. It looks from the outside like the interest rate sensitivity of the economy in this cycle has been very muted, very different than in the past. There's also you look at the economy, they look like there's very differential impacts across different parts of the economy. The housing market, people have long-term fixed-rate mortgages, so interest rate pass-through there is very low. Here in Silicon Valley, we have early-stage growth businesses where the cost of capital is affected by the higher rates, and there it looks like we have a much bigger impact. So I wonder if you can speak about the interest rate sensitivity of the economy in this cycle. And then another question, a related question, which is we have differential impact across the economy. How do you think about balancing the impact of interest rate hikes on different sectors?
So I guess the headline for me would be that I do think monetary policy is working and working broadly as expected. I think you can point to sectors of the economy, and you mentioned a couple. So if you're a household that has a low interest mortgage, you're not feeling the effect of higher mortgage rates. And many companies as well took the opportunity to term out their debt before rates went up. So you have a lot of companies that have longer term fixed rate debt at pretty low rates, and they're not as affected by it. That's all true. At the same time, again, if you look at interest sensitive spending, either in housing or durable goods, you're seeing very significant effects there. And I do think you see the economy rebalancing. So I think it's not right and maybe too soon to conclude that there's some significant disconnect there in terms of monetary policy transmission. But it still leaves the question of how the economy can have grown over 3% during a year in which the federal funds rate is at a quarter-century high. Why wouldn't growth have been lower? And to me, the answer to that is the supply side recovery. I think that's what people need to understand, is that you have this force from outside. It's not just interest rates and demand. You've got a supply side recovery that is creating new demand and new supply. And that's why you get a number like 3.1% at the same time inflation is coming down. One of the reasons why. So I think that's really the story. It's not that the policy isn't restrictive, and it's not that the economy is not responsive to rates. It's that we've had this outside force that is temporarily affecting that.
So if I benchmark Fed policy right now, we have rates at 5.3%. Inflation is running a little bit under 3%. That's like a 2.5% real interest rate. That's really the real cost of borrowing. Compare this to pre-pandemic, we had real rates of close to 0, maybe 0.5%, sometimes negative. So we've gone from a very low rate environment to a very high rate environment. Policy looks tight right now. Another benchmark, I don't know if my colleague John Taylor is here, but the Taylor rule is a typical benchmark we use for thinking about a central bank policy. And by the Taylor rule, policy rates right now should be around 4. So policy does look quite restrictive right now. And I think in talking about where policy is right now, you've said that the risks are balanced. Why continue to have tight policy in an environment in which the risks are balanced?
So we do think that policy is restrictive. We think it's doing its job. I would go back to what I said in my remarks to start, which is we think the risks are two-sided. So there's a risk of if you cut too soon, the risk is that the progress on inflation will stop, or that even it will reverse. And we've seen that in some historical, particularly in the 70s. We don't think that's what's happening here at all, but that's a risk that we have to manage. The other risk is that we wait too long or move too slowly once we do move, and in that case you have weakening in the labor market and economic output. So we're trying to steer between those two risks. Obviously, we're trying to be in the middle and get the timing right. It's very challenging. There is no risk-free path, but and I think we're in a position to address the economy moving in either of those directions. So the risk, though, of moving too soon really is that the economy really does, the inflation does move up, and then it really would be quite disruptive if we were to have to then come back in. We will do what we have to do to get inflation down to 2%, but again, it's about balancing those risks. It's never the case that you can confidently look at the baseline and say, this is what we're going to do. It's always about having a baseline understanding, but then knowing what the risks are and having the committee be in a position to be able to address those should they materialize. And I think we're very much in that position now.
Maybe I can just follow up on that. So I'm going to ask a question about, is there a signal or a data point that you're paying particular attention to over the next year? And I'm going to ask it this way. So if you had a crystal ball that you knew could perfectly answer one question about the next 12 months, what question would you ask it? What's the thing you really want to know?
Sorry, there's no one thing. It really is. We have a dual mandate. You're asking me to be single-minded about the dual mandate.
No, just kind of a data point that you think will guide you.
Can't do that. No, I mean, we have to, I would say this. In our framework, the two goals, price stability and maximum employment, are equal under the law. But our framework literally says that if you're very far from achieving one of the goals and the other one is pretty much at goal or even better than goal, then you focus on the one that's far from goal. This is obvious, right? So, and that's what we did after inflation came up in March of 21, and then we really had a very tight focus. And you heard us talking about, getting inflation under control. But as inflation has come down, the two things are moving back into balance. And we're not a single mandate bank. The key thing I'll end with, though, is price stability it gives us the ability to achieve both goals. If we don't have price stability, then we're not going to have these long periods of tight labor markets, which benefit everyone. What we saw in the 10-year, 8-month expansion that ended with the pandemic was, for the last 2 or 3 years, the people at the lower end of the income spectrum were getting the largest wage increases. And you saw the gaps between black and white unemployment go to historic lows. So a tight labor market over a long period of time does enormous social good. And that's what we all want to do, is we want to get back to that. For that, you need price stability. But so the two of them actually are quite complementary.
I'm going to shift from just talking about the near term to thinking about the longer term for the U.S. economy. We've had a pretty big shift in growth expectations for long-run growth. This comes out from the Fed's own projections as well as from economic forecasters' projections. For 15 years ago, long-term growth forecasts were 2.8%, 3%. Pre-pandemic, they've been below 2. That's kind of where they've been for long-term growth forecasts. That's where your own forecasts have been. Why do you think that is? Why long-term growth at 2%? We're sitting in Silicon Valley. AI is all the buzz here. We've had high growth over the last few years. Is 2 a reasonable number? Is it possible we could go back to the 2.83% that we had in the early 2000s?
So let me start by saying that sort of every bit of the economy is difficult to forecast. There isn't one that's more difficult to forecast than productivity, for example, which is one of the key elements of longer-term growth. So it's very, very, very uncertain. I mean, basically, what longer-term growth is a function of growth in hours worked and of output per hour. And hours worked is really a function of demographics and more than anything else. And productivity, output per hour, is highly unpredictable. So I think people lowered their longer-run growth expectations to around, I guess, 1.8% as the median, something below 2%. That's given what had been our very low population growth and expectations that productivity might be 1.5%, 1.5% kind of thing, productivity growth in output per hour. That's a pretty good place to be. We've had higher productivity than that recently, and the question is it going to be a sustained thing? Are we going to enter into a new period of higher productivity? That would be great. It is productivity growth that lifts, all boats, generation upon generation. And so people argue AI can be that effect. Some people are arguing that there were a lot of business starts at the beginning of the pandemic and during the pandemic, as Americans went out and started businesses at that time, and also that you've seen a lot of change in the labor force. So people moving, quitting, going to better jobs that might be better suited to their skills. But all of those things, they could become a longer run productivity increase or not. Those might just be the things that we need to get 1.5% productivity. And it is unknowable. And particularly with AI, the range of potential outcomes, it should increase productivity. Everyone sees that. But that's not what we're seeing in the numbers now. It's too soon for AI to be affecting, I think, the productivity numbers. But the logic of it is that it could actually increase productivity. And then the question will be, what does it do to labor? Is it going to replace labor or augment labor or both? And if so, in what proportion? So hard to say about longer run growth, but of course, it would be great if that were the case.
And then just to follow up, we talked about this before. Do you feel like you need to take a stand on this in policy making at current?
No, I mean, so our focus, the things that are really important to the U.S. economy over time are productivity, immigration, even trade policy, the things that we're doing, industrial policy that is now a thing. Those are important to the longer run growth and economic well-being of Americans. And what we do is we try to move the economy towards stable prices and maximum employment through the business cycle. That's what we can do with business rate, with monetary policy. We are also a crisis responder. We're a really important crisis responder. We can get there quickly. We have great tools for it. So that's a key thing that we do. We also regulate and supervise the banks, and it's important, and we look after financial stability. So all those are very important things, but they're not things that affect the longer run potential output of the United States. So honestly, though, so the question of what will be the equilibrium interest rate, the neutral interest rate going forward, doesn't really matter for policy today. We're really asking about once the pandemic is well and truly behind us, and we're well into the AI investment boom and the effects of AI, what will that look like? And it doesn't really matter that much for getting inflation down to 2% while keeping the economy growing and the labor market strong.
Can I shift tacks and talk about some of the challenges of leading the Fed through the last 5 years? So, just in our discussion, and it's clear from looking at the world, you've had so many different shocks. Economies behaved in so much unusual ways over the last few years. You were appointed Fed chair in 2018. I remember pre-pandemic, the dominant concern of the Fed was low inflation, not high inflation. It was having inflation below target, below the 2% target. COVID happened. We've gone in a completely different direction. So can you just speak about the challenges of taking an organization that was focused on one thing to focusing on something completely different?
Yes, it's certainly been a turbulent time, I will say, to Dean Levin's points. It's been really a lot of things and things that weren't expected. For 20 plus years around the world, economies suffered from lower interest rates, lower inflation, slow growth, low productivity, bad demographics, and a lot of monetary economists were working on how do you make your tools work at a time when you're going to be bounded by zero, and you won't be able to cut and support the economy. So this was a big thing, and then the inflation that came, it really arrived in the first quarter of 2021 was a surprise to most people, and again the macroeconomists generally thought that it would go away over time. Not everyone. There were some concerns expressed, and ultimately it is coming down significantly. So that was, we had to pivot on that, and we did. When it became clear, really in the fall of 2021, it became clear through the labor market data, the inflation data, the growth data, that the economy was not moving back toward price stability. And we pivoted, and when we pivoted, we really moved. So because that was the right thing to do. So the good news about monetary policy is it can move quickly. The emergency tools we have, as I mentioned, are agile compared to other government policies, and they have a significant effect on the economy. So I think we've gotten to what is, knock on wood, a pretty good place. We're using our tools now to try to bring inflation down the rest of the way to 2% while keeping the economy strong and the labor market strong as well.
I mean, the other side of this tumultuous period that we've been through is the external pressure from the Fed, from outside over where to set interest rates. And you have faced this pressure over the last 6 years, including from the former president. So how do you navigate the decision-making of the Fed in the larger scheme of pressures coming in from the outside?
So the thing is, Internally, we have peace of mind on this because everybody who works at the Fed knows that we're going to do what we're going to do, and we're going to do it for economic reasons, and that's it, as I mentioned in my remarks. And I mean, I think you can go back and look, anybody can read the verbatim transcripts of the things that we discuss during. It doesn't matter what the election calendar is saying. Whatever's happening in the economy, those are the decisions. We make decisions based on the analysis that I described in my remarks. So I think we know that. So it becomes, but it's a communication issue that people need to understand that that's what we do. It's always what we do. If you look at the modern historical record, you'll see that the Fed has been prepared to move or not move and do what it thinks is the right thing for the economy in the medium and longer term without regard to kind of outside considerations. And it's important to just have people know that, which is why I brought it up. I don't have concerns that that it's going to be a problem for us because we're going to do what the right thing is for the economy over time, and my colleagues and I are tightly focused on that.
Maybe you can just say a little bit more about that. I mean, you're praised by many people in your ability to build consensus. You've served in different White House administrations with different political ideologies. How do you do that in practice? Do you have any advice for all of us? And
so it boils down to two things. One is, we have a specific mandate. Stick to that mandate. Focus on that mandate, and don't be dragged into partisan political fights around. I mean, when I testify, people are always trying to get me and my colleagues to support their perspective on fiscal issues or immigration issues, and they think of an economic hook, and they try to. But we just don't do that. We stay. That's part of it. The other part of it just is. I spend a lot of time in our system of government, oversight comes through Congress. In a parliamentary system, it's through the elected government, but because that's the same people who are in the parliament. But for us, it's not the administration that has legal oversight responsibility. It's the Congress, the House and the Senate, and particularly the two oversight committees, one in the House, one in the Senate. And so my colleagues and I spend a lot of time, and we don't go up there to blast talking points at people. We want to hear what they're thinking, and we want to listen carefully and respectfully and tell them what we're thinking. And I think people appreciate that. That's the thing. Same thing internally. I think when you listen respectfully and understand what people are saying and try to think about how to incorporate that thinking into what you're doing, for most people, most of the time, that's going to be enough. And so they can go along with things that they don't 100% support, but they feel like they were heard, or they're not going to maybe criticize quite as harshly as they would, because they realize that you're doing this in good faith to the absolute best of your ability and based on the actual facts and what we know about the ever-evolving economy.
And can I just ask about how your own background has helped in this process? So you are a person who has shifted between the public and the private sector over the course of your career. And you're a lawyer by training. You don't have an economics PhD. You're running an organization which is mostly a PhD or many PhD economists. So can you just speak about how your background has helped you navigate this?
Sure. So when I graduated from college, I had no plan other than this idea that I liked what I saw of the careers of people like George Shultz or Cyrus Vance, for example. And that the idea was these are people who had a mainly private sector career, but served in the government at intervals and were able to do public service. And I grew up in Washington, D.C. My family was not involved in any of this, really. But this is what I observed, and I thought I would like to do that. And by some miracle, that's kind of what happened. It wasn't careful planning. So I always wanted to do public service, and I wound up doing that. I served as an aide on the Hill. I was at law, all these different things that I've done. So that's how that happened.
And then I'll ask one last question for this. Do you have any advice for the students in this room whose interests are to move between public and private sector?
So I think that's a great plan for people. People have different tolerance levels for volatility. So, I mean, I quit the law and went into investment banking, quit investment banking and went into private equity, quit private equity and went into public service. So if you're willing to tolerate volatility and steep learning curves, I mean, then if you're that person, then that's a great way to go. The other thing I'll say, though, is I have really found that when I was a partner at a private equity firm, I asked the, the head of the investment area, what do you look for? I mean, it's all about picking good CEOs and good business models. What do you look for in a good CEO? And the answer was, you know, there's no one model. And that's really important. I have seen very different people be successful in leadership roles, very, very different people. And it's in, I don't know if it's in every person, but it's in a lot of people to find your own way to lead. And you don't have to be one way or another. You know, I can think of one person at the Fed she had a way of being a very soft talker, and by the end of the meeting, everyone was leaving there thinking, how do I do what she said? You know, it's like, I want to do that. It's in everybody, and you should have the self-confidence. What I experienced when I first had to lead things was complete lack of self-confidence. Oh my God, I'm not ready to do this. And I think that's very common for people. I think people get more coaching now, but I would just say, be confident in your own abilities to lead and take things on and take risk, because that will, if I could say that to something to my younger self, I think that would be it.
Jay, we're running on time here, and there's lots more stuff we could talk about, but I'm mindful of time. So let me just first of all thank you on behalf of Stanford for being here, engaging us in this conversation. It's been very stimulating. I know I learned a lot, and I hope we all learned a lot. And again, so thanks very much for your time.
Thanks, Robin. Thank you.
All right, guys, so that is Jerome Powell here. Let me know what you guys think. We are going to sit around and day trade for a little bit on Apex funded account programs. Before we do that, though, check out our sponsors. We're day trading on Apex today. Let me know what you guys thought about Powell. I thought he was pretty dovish. You know, I think we'll still probably cut rates this year. I'm going to go with a neutral report here personally. I think it was mostly neutral. I thought that he could say more to benefit the economy and the market, but it's also kind of a flat day. We're going to take a risk here and try to day trade this. Yeah, again, I thought he could have said more, but overall, I hope we wait to cut rates. I don't think it's good to cut rates this early. I think inflation problems might arise from that. And I did hear him mention that specific fact. So we're already up. We're going to go take a little bit more off here. Again, we are scalping the futures market, the S&P 500. We're going to go take a little bit more off here, grinding this up. We'll take one more piece off, locking that profit in. And so not too bad here. Again, guys, we are going to be day trading. Let's go ahead and buy this and maybe scale into some more size here. We're in 4 contracts. Again, we are day trading on Apex funded account programs. What Apex does is they're really useful. They give you a demo and they test your skill. And if you can pass the test, they fund you the same amount. So the base one is $25K. They give you a $25K demo account. It only costs $30 or $35. If you can pass the test, you only got to make $1,500 in profit without losing $1,500 first. If you can pass that test, they fund you $25K with a 90% split. If you can't pass the test, you know, you're only out what you pay for the challenge, which, you know, in this case is $30, $35. And so it creates this situation in day trading when you're learning to day trade, or if you just don't, or if you're a good day trader, you just don't have that much money. It creates this situation where you can learn to day trade, potentially get funded with a 90% split. So once you're funded, you're keeping your profit anyway, most of it at least. But if you lose, your risk is profoundly limited. So it limits your risk. It's the best of both worlds, in my opinion. And in the futures market, you can see I'm day trading the S&P 500, like basically the SPY price action right now. Actually, this is the NASDAQ 100. So this is basically the Q price action right now. There's no PDT in futures. I can day trade short, limit my risk, and learn how to day trade with less risk here. I'm going to go and take half of this off just to lock it in, just to be safe. And if it turns against me, I'll still be pretty safe. But again, you can see another benefit of using Apex is that you can use micro contracts. And so again, if you want the max discount, always use promo code BT. Beginner Trading, BT, all one word. Remember, they are a sponsor of mine, so I'm certainly biased in their favor because they pay me money, and I'm very honest and transparent about that. There's the link. Remember, I have no idea what I'm talking about. I might be wildly wrong about anything and everything I say. Understand Rule 4.41 from the CFTC. Hypothetical or simulated performance results may vary. I also day trade a ton off stream, so you're not going to see all my trades. Yeah, and I'm pretty honest about it. So, but again, great way to learn day trading with limited risk. And again, to be fair, I think most day traders lose. So I think most day traders are going to lose this as well because most day traders lose. But frankly, I think it's a lot cheaper to lose here than it is to put up 20 thousand yourself in stocks, trying to day trade stocks. And again, the no PDT thing makes it really beneficial to learn with futures instead. And you can always pivot to stocks. Say you're good enough at futures trading, you take a couple withdrawals, you fund your own stock account, and you can day trade the SPY or Q directly if you want, but your risk is just noticeably limited. I use Rhythmic. This is Quant Tower. So this is a platform called Quant Tower that you can see on the chart right now. So yeah. Oh, it's definitely, it's not really a script. I don't really read anything except for what I just said. I've mostly memorized it. I plug it enough. Oh no, don't fall against me. All right, we're gonna have to cut this. We'll wait. We're kind of choppy right now. I mean, really, we're pretty flat from this report. Flat on the day as well. Undervalued stocks. Yeah, I mean, I swing trade, I invest. I'm not purely a day trader. Like, I do economic content mostly. I mean, we got 3,000 plus people here for a Jerome Powell speech. So we're mostly economic reports, but we day trade, we swing trade, we invest, we do all that good stuff. Again, my big thing, like, I think diversification is powerful, and I think you should diversify. So, like, you know, I think if you're not diversifying, you're making a mistake. You know, I think most smart traders are going to diversify into things. And, yeah, I think that's the right move. And this as well. Okay, so we're bouncing right back up. I don't know how I feel about this. I mean, the market's been mostly strong today. I guess I tend to think things are going to bounce back. So we'll try to take a longer term position here. With 4. Oh my gosh, I got 12 contracts. I just bought 12. I didn't mean to buy 12. Oops. What's half of 12? 6. Okay. All right, well, we just took half of that off just because we took way too big of size there. Somehow it worked. Yeah, we're scaling out of this. Somehow we just got really, really lucky and got out of what would have been a huge risk trade. Yeah, we just made some money, so that's good. I'll buy a little pullback here. If we pull back some, I will buy this dip. We're also going to be doing a crypto show today, chat, so remember, stick around. We are going to be doing a crypto show today, so be ready. All right, so there's the dip we wanted to buy. Actually, that's a large dip. I'll buy a small piece. It is the middle of the day here, so I don't think day trading right now is necessarily like a perfect move, but it's all good. All right, so we're down a little bit. I'll add a little bit more to this, see if we get a quick little pop. But again, you can see it's very similar to day trading stocks, like day trading futures. All right, we'll take half of that off, just protect the trade. Take a little bit more off if we continue to bounce. It's very similar to day trading stocks. There's just no PDT rule, right? Like I'm day trading the QQQ price action. It's what's called the NASDAQ in futures. Wait. There it is. All right, so we're flat on the remaining position. Now we're bouncing up a little bit here. We'll watch it. We'll hold the rest roughly break even. Like, I'm not going to take too much risk here trading this. We've already built up a nice little cushion on the day, and now we can cut that with limited risk. So green on the day slightly now. Again, we are going to do a crypto show today, chat. So we are going to do crypto today. Let me make sure we're doing the right one. All right, so we did get a pop-up. We're not doing too bad here. All right, so I'm probably going to close it down. Guys, listen, we're going to do a crypto show today, so don't go anywhere. We're about to pivot over to our crypto show. And so you won't have to go anywhere. As soon as we close this stream, it's going to bring you to our crypto show. If for whatever reason it doesn't bring you to the crypto show, you can go to this link. But again, as soon as we close this stream, it should immediately redirect you to our crypto show that we're about to do right now. So again, stick around. We're going to talk all the big news in crypto. And yeah, it should immediately redirect you there as soon as we close this stream. So don't go anywhere. Stick around. And yeah, let's the link for Apex Trading is right here. So if you want to check out Apex, again, just use promo code BT, Beginner Trading, BT, all one word. You can find it in the description. You can also find it right here. How are you a day trader and this scared to get in the buy? Well, I mean, I think right now it's freaking noon market time. It's like 12 to 1 p.m. market time, so it's not really the most ideal time to trade. I think this morning in pre-market it was choppy, and so I think you always have to have some fear of markets. If you don't, you're just gambling away your money. If you weren't doing this, you'd be doing roulette. You know what I mean? Like, I think you have to fear the markets a little bit. Smart traders don't need to gamble and throw crazy big gains trying to look cool on the internet. I would rather trade small and safe. And again, my TOS account, like my Thinkorswim account here, has, you know, $250,000 in buying power. It's got 70,000 liquid in it. So, I mean, my account's not small. We're not new either. But yeah. Y'all be safe. Again, if you want to check out Apex, here's the link. Again, Apex's funded account program gives you a demo. They test your skill. If you pass the test, they fund you. If you don't pass the test, again, you're only out what you pay for it. The base one is $25K in funding. If you pass the test, it's only $35. The top one's $300K. I think it's about $200 to take it. But once you're funded, you get $300K in funding with a 90% split. Again, they're a sponsor of mine. I'm definitely super biased in their favor because they pay me money, and I can't guarantee any of this. You want to check with them to be safe. Another sponsor of mine, and again, we posted that link in the description. Also, chat. Another sponsor of mine is a company called Chart Prime. It's a trading view indicator service. You could use it stocks, crypto, forex, futures. I always like try to show people how accurate they can be and like back test this live. So like let's check it out here. So again, buy signal, bounce, sell signal, drop. And this is a 5-minute chart. Buy signal, bounce, sell signal, drop, buy signal, bounce, sell signal, drop, buy signal, bounce. Look at this sell signal literally called the very top. And again, I can't guarantee these are going to work either. Nobody can, but look at that. Literal hours and hours of breakdown. Look at this buy signal almost at the very bottom. Beautiful, like, hours of breakdown. Sell signal, beautiful drop. Buy signal, bounce. This one was probably wrong. This one definitely worked. Look at this one, sell signal, drop. Look at this buy signal way back here. Beautiful bounce. This was chop, and so I think ignoring them during choppy periods makes sense, and attacking them in good periods makes sense. But again, this is like $40 a month. If you go back, it's actually pretty impressive. Like, these don't repaint either. So look at the sell signal. Beautiful drop, buy signal, beautiful rip, sell signal, beautiful drop. This one was wrong. This one definitely worked. 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 So again, I challenge you to backtest it yourself. Again, you can use this in stocks, crypto, forex, futures. There's oscillators, screeners, backtesters. They're a sponsor of mine as well. And yeah, I've heard a lot of people talk about Chart Prime lately. Again, I was always against companies like this, to be completely honest. But they actually showed me their indicators one day, and I was impressed. Like, I was genuinely impressed. Again, I can't guarantee anything's going to work. Find moments in time where they're working. 1-minute chart, hourly chart. The hourly chart is actually pretty nice too. Like, look. Like, here's an hourly chart. And again, I can't fake this either. But, like, check it out. Look at the buy signal show up. Boom. Sell signal. This is literal days of breakdowns from the sell signal. Beautiful breakdown. Buy signal, nice little rip. Sell signal drop. The hourly chart might have worked better than any of them. So again, I challenge you to backtest these yourself. They're pretty impressive. I can't guarantee you're gonna make money. Nobody can. They're a sponsor. I'm biased. No, that's actually wrong. G. They show up about a candle later, so you don't see them. Look, okay. Here's an example. This buy signal just showed up. Just showed up. What? Definitely not before the trend. So, like, look, it's definitely not after the trend is over. It's about a candle later. You see the signal show up about a candle later. Anyways, you can check out the link for that in the description as well. Again, we're going to move over to our crypto show, so I'll see you guys over there. Let me make sure it's going to route you guys there. I'm pretty sure it is. And, yeah, y'all be good. Yeah, so, okay, it's going to redirect you guys there. I'll see you guys over there. Good luck. Again, if it doesn't bring you there for whatever reason, go to this link right here. It should immediately pivot you over there. Yeah, we got a separate channel for crypto. Link is in the description, DM. It's called Chart Prime. If you use my link, you get 40% off. But yeah, I'll see you guys over there. All right.